Mecklai. Thank you so much, sir.
Up here? All right. Well, hold on. I don't need that. Just get that one. Right? All right, let people settle down. Is this on? Is live? Yeah. Oops. Good afternoon, everybody. It was quite an interesting session, because all the countries represented, with the exception of Turkey, India has almost no exports to them. So it's sort of be curious as to how, what value they could add to Indian exporters, which is why I think the focus was really more on investment rather than trade. So I'm going to go from the sublime to the ridiculous, right? Foreign exchange, I assume some of you or most of you are in exports. So I will speak on where is the rupee going. Well, the short answer, this is how I do it. How do I do this? No? Arrow. Oh, where is the laptop? No, how do I move the slides? How do I move the slides? I just need to move the slides. Shall I just tell you what to do? Next slide, next slide, next slide. All right. Left, right. Just next slide. So where is the rupee growing? The short answer is I don't know. But really neither does anybody else, The longer answer, I always say it's best to discuss over cocktails, where you can talk on A and B and C and D, and you still won't be any the wiser. I mean, which is the nature of markets. Can I get the next slide, please? But, since we're here and we're talking about it, let's explore a little bit of history. This is the rupee over the last 2 years plus, right? As you can see, for most of 2020, the rupee was volatile, but largely stable, right? At that point, there was increasing concern in global markets about inflation. And the Fed, doing what it does best, I guess, was not buying it. They kept talking about it being transient, And markets knew it wasn't, but the Fed was not willing to raise rates. So markets were they were getting nervous, what's called a risk-off mode, Well, no, let me correct that, sorry. Since the Fed was not doing anything, markets were in a risk-off mode, and equities shot higher. About 20% during 2020. By 2021, though, it was becoming clear that actually US inflation was real. And things turned on their head. Next slide, please. Now, the blue line is really what happened since, I think, October or November 21, right? We're now in 23. And the green line is what happened to the Dow in 2008. I just happened to be playing with the numbers and looked at it, and for the first 6 or 8 months, I was terrified. Because, in fact, I call this slide fear. Because it really looked for the longest time that it was just following it to a T. And nobody knows what's going to happen. I didn't know what was going to happen. So my concern was, my God, it had fallen like 20%. But in 2008, it fell by 50%. Could this happen? And the thing that was even more concerning is in 2008, after it sort of bottomed out and turned around, it took I think 4 years or a little longer for markets to come back. So, by June 22, I was thinking, my God, the world is ending again. You know, fortunately, it didn't do that. You know, you see, equities bounced back, things seemed to stabilize. I can have the next slide, please. And one of the things that had happened was the dollar started rising. You know, as the Fed started waking up and raising rates, you know, the dollar index just woke up from a deep slumber and shot higher and higher and higher and higher. Equities had stopped falling by then, and the dollar was going up, right? It went up by more than 20%. And of course, next slide, please. All currencies in the globe fell in tandem, you know, more or less. We look here. If you see, but the way they fell was a little up and down, okay? The rupee, oddly enough, was one of the best performers, right, in the first 6 months. It lost 6% together with the Chinese currency, but the yen was 18%, sterling was 10%, the euro was about 8%, right? And the dollar peaked against each of these currencies in late October, November. But by that time, what had happened, the rupee's fall caught up with everybody else, okay? The yen was the 30% down, sterling was 17, the yuan was 16, and you see the DXY was 17% up, but the rupee was only 11% down, right? Like I said, it was the best performer in the house. However, when it stopped, when the dollar stopped rising, right, everybody else sort of turned around and recovered most or a lot of their losses. You see, the euro is only 4% down. The yen is still down 11%, but it had fallen 30%. But the rupee remained on the ropes, meaning it did not recover anywhere near as much as anybody else. Okay? So that's sort of the history lesson. Can I have the next slide, please? Because I guess what's of more interest is where do we go from here, all right? Well, you know, I wrote this over the weekend, and the first line, first off, the current bout of dollar strength appears to be over. Well, guess what? It turned around, right? The dollar index was at 100, it suddenly shot up to 103, which is why I come back to my very first slide, which is I really don't know what's going to happen. Nobody knows what's going to happen, right? And because markets do that. But leaving the details of the up and down of the market, I mean, just looking more structurally, markets remain off balance. While they want to believe that the Fed has got inflation under control because of having raised rates so high, but I don't believe the Fed has inflation under control, right? And the fact is that it's, and what is more important is there is a structural issue here because the Fed's job is to contain inflation to a level of 2%. Now, I think that is the fundamental flaw. See, that target of 2% was set at a time when there was the China price, when globalization was going full on, where all your supply chains were working perfectly. India was coming into, with low costs, was coming into the economy. 2%, great. I don't think they're going to be able to reach that. I mean, prior to that, the average inflation rate was 4.5%, which was still considered good. But if the Fed is going to suddenly wake up tomorrow and say, okay, we're changing the target from 2% to 3% or 4%, the markets will scream, right? Which is why next slide, I keep looking at this slide every day, same one, because you really don't know. I mean, where is it going? If the Fed is not able to reach its target, which I believe is a fact, no facts in the market, but I believe the Fed is not going to reach its target. So what is going to happen? Markets are going to remain volatile, uncertain, falling from time to time, I don't believe it'll get to that, but I mean, we have to realize that, see, there's lots of bigger issues, One, fundamental issue has to do with really the US Fed for the last, since the 80s. You know, one of the things is that the Fed keeps, since 87, since Greenspan was the chairman, the Fed has been telling the market what it is going to do, right? Acha, ab ye karne wala hu, ye karne wala hu. So people who are invested, you know, it becomes taking, risk sort of gets eliminated. It becomes very easy for them to take decisions. I have a cousin in Switzerland who is in the real estate business. And he said, he was laughing. He said, it's a joke. I know interest rates are going down because the central banks are all telling me that. So I will set up a project with very large borrowings and just refinance it as I go along, right? So for decades, the Fed has been holding the market's hand, right? And so in many ways, at the 87 is when Greenspan said that, what are we looking at? About 40 years or 35 years, right? And so what that means is a lot of people who are in the market today don't know what risk is. They don't know how to price risk, which is why, like I said, I still look at this graph every day. I mean, you hope and pray it's not going to fall like that. But the reality is if there are these structural problems, that people don't know how to value risk, for years they've been depending on the central bank. Now, as it happens, the markets believe they know more than the central bank. So I'm saying we're in a very, very unstable situation, you know. And frankly, I don't know what is going to happen, as I said at the start. Can I have the next slide, please? So while the dollar has perked up right now, my belief is dollar strength is not going to return for some time, you know, at least not in this round. So markets will remain risk off, okay? When the dollar was strong, it was risk on, come on, you can invest in emerging markets, et cetera, et cetera. So I feel this uncertainty and volatility is going to keep pressure on the rupee, right? Current account deficit is in very bad shape, but the RBI governor, who frankly I believe has done a very, very good job, every single time he opens his mouth, he speaks about we can handle the current account deficit, you know. So what I'm saying is there'll be downward pressure on the rupee from the global uncertainty, which may last for another 2 years or whatever, right? So that's going to remain. On the other side, despite the Adani story, India looks good. You know, the rest of the world is wobbling. We are good. People are investing, you know. So there will be this back and forth. There will be increased volatility. But the real trick, you know, is, in my view, is the rupee today is so hugely undervalued. I had a friend from the US visiting me, January, and he was from New York, and he was walking the streets, and he came home one day, and he told me that I bought a banana for 1 rupee. Oh, sorry, 5 rupees. 10 days earlier, at JFK, he had bought a banana for $2.50. Now, we know at airports prices are inflated. So let's say it's 5 times inflated. So if you use a banana as a model, 10 rupees would be 50 cents, you know. So there are any number of examples. People, you live overseas, you probably see it. India is cheaper now than it's ever been. The Economist, they run this Big Mac index. They found the rupee to be the most undervalued currency. It was 40% or something undervalued. So to my mind, you know, on the one hand, the rupee is much too weak. When there is global pressure, people pull money out, the rupee it threatens to get weaker. Now, what happens if the rupee is too weak? You're sort of giving away your assets, right? If somebody comes in and invests here when the rupee is much weaker than it should be, you're giving it away. So it's a tricky game to play, which sort of explains why RBI definitely doesn't want the rupee to weaken. But the market is the market. However strong you are, $600 billion of reserves can only hold you so long. So, I come back to the starting point, which is I really don't know, but I do know it's going to be very volatile. And if I can have the last slide, please. But I assume some of you here who have exposures, right? What do? Right? I mean, I've been in this business for a long, long time, and frankly, in the beginning, I used to believe I knew, right? But in the beginning, which was in the 80s, the market was very easy. You could kind of figure it out. And things didn't move as much as they did. But right now, the truth is you don't know, your advisor doesn't know, your bank doesn't know, I certainly don't know. So you cannot and should not depend on what somebody tells you is going to happen, right? You should never stay fully unhedged. I mean, that is very irresponsible because anything can happen. And if you're sitting nanga, you lose your pants, right? You could hedge 100%, just by chhod do, I've covered my costs, let me go. Now, the problem with that is if the rupee weakens, as it has sometimes, you're going to end up looking at some serious mark-to-market losses. Your accounts will look like hell, So particularly for exporters, they generally, and the other point is exporters historically are accustomed to the rupee falling and they didn't hedge. So very few exporters would be hedging 100%, in my view, 50% hedge is not bad. Aadha kar do. If you don't know what's going to happen, aadha kar do na. You'll do okay. I'm assuming that you're reasonably profitable to where, you're not going to lose your margin. But what we believe, and as I said, we've been doing this for a long, long time, is you need to take a little more of a structured approach. You start out with a stop loss, first things first. If you've got, let us say, $200,000 or $2 million coming in 6 months, you value it today's forward rate, you set 2%, 2.5% as a stop loss, and your job is to make sure that whatever happens, this is the worst rate you will get. So how do you ensure that, right? Well, first, again, I mentioned before, you don't sit nanga, you hedge some part up front. And then you have a set of rules. If the rupee moves favorably by 50 paisa, you hedge some more. 50 paisa, you hedge some more. But if it goes against you, and this is where companies fall apart. If it goes against you and threatens your stop loss, exit. We've developed like I said, follow with discipline, which is the most, as we all know, that is the most difficult thing in life. And it's the most difficult thing in business, right? Which is really why the Swiss and the Germans are so good at business, because they're very disciplined people. So we have developed a model that helps you do that. This model has beaten, I think, 163 out of 167 treasuries, or some such number. I can't remember exactly. And it's not that it's very, highfalutin or anything. The main thing is it's disciplined. So that's really all I had to say about the rupee, which is I don't know anything, and follow with discipline. All right? Thank you.
Just one question. You gave the banana example. So while it works at the sustenance level, the basic food and basic thing, but if you just start moving up the value chain, the houses are very costly. Cars are sometimes costlier than US and India, the same car. So
I think that if you leave the banana and talk about the economists thing, they say it's 40. I mean, they take a regular basket, and it's 40% weak. I mean, houses are costly in some parts of Bombay, right? I mean, and again, the other thing, the real estate market in the US has certainly gone up. It's turning and coming down. See, you have to compare like for like, right? You can't compare a flat in South Bombay with something in Idaho. I mean, I don't think houses are that much cheaper, or cheaper in the US. Do you find?
no, I mean that 50 times thing multiple doesn't hold.
No. That is absolutely.
So
that's what I said.
places,
I'm not saying the banana index, right?
and
But the
these
burger
cultures,
index is that it should be I think it said should be 40% lower. So it should be about, 50 rupees or something like that. Now, but see, you're not going to get there, right? And see one other thing. Let's talk about export competitiveness. Today at 82, 83 rupees, most exporters will make money at 78 or perhaps even lower. And it's not that because you're looking at 82, 83 rupees, you're getting a huge push in exports. Okay, granted, global markets are down, so it's difficult to sell, but we are not really getting a push from the currency. It's very hard to say what is the right value. My sense is RBI has some, why would they prevent the rupee from weakening if they felt it was going to help? So no, it's certainly not. It's not 10 rupees to the dollar. That would be hell. Thank you.
Request Mr. Raje to present and Mr. Sandeep Khosla. Okay, Mr. Sandeep Khosla to present a token of appreciation to Mr. Mecklai.
Thank you very much, sir.
Thank you.
Thank you so much, sir.
I didn't tell you, I like your new office. When did you all move here?
With the new Director General.
Fantastic. Well done. Well done. Good luck.
Thank you. Come. Just continue, no break. And anyone who wants to have people, they can go and have and come.
Okay, fine.